When a strong technical breakout suddenly and violently reverses, it triggers a stop-loss cascade that can liquidate a retail position in seconds. The current upward momentum in the market lacks the volume profile associated with organic buying pressure. This price action is a mathematically engineered sequence designed to draw in late-stage buyers before the liquidity is pulled. This is the Liquidity Trap Paradox. Short-term green candles on the lower timeframes create a bullish narrative that masks a massive incoming rejection at the macro level. Protecting your capital during this cycle requires an understanding of how these liquidity traps are structured and executed by market makers. To survive the volatility of the coming week, you must prioritize the underlying mechanics of market liquidity over emotional reactions to immediate price movement. The divergence between macro weekly data and the 4-hour micro data reveals a structural contradiction in the current trend. On the weekly time frame, we are seeing a significant bearish divergence. While the price continues to rise, the momentum indicator is trending sharply downward. This macro divergence indicates that the structural bearish trend remains in effect, regardless of short-term price spikes. This stands in direct contrast to the immediate 3-day and 4-hour charts, which currently show a burst of bullish momentum. These signals represent an oversold relief bounce, a mechanical reaction to previous selling pressure rather than a trend reversal. A similar relief bounce occurred in July 2022, where a multi-week rally convinced many that the bottom was in before the market continued its descent. Retail traders often misinterpret these technical bounces as the beginning of a new bull run, ignoring the larger context. Immediately above this relief rally lies a significant macro resistance block that has historically halted upward price movement. This resistance zone is strictly bounded between the 72,000 and 76,000 price thresholds. Trading the micro time frame without accounting for this 72,000 level resistance creates a high mathematical probability of being caught in a reversal. Institutional price action is consistently drawn toward areas of high retail liquidity to fulfill large-scale order requirements. Currently, a massive cluster of retail liquidity is sitting at the 74.1K level. A liquidity heatmap visualizes this concentration of pending orders as a primary target. Short-term trading algorithms will likely target this cluster over the next 48 hours to wipe out those positions. This creates a deceptive bullish push designed specifically to clear this liquidity band before a potential move lower. During this event, we can expect volatile price wicks to extend as high as 74.4K as the order book is cleared. The second this liquidity is consumed, the mechanical drive for higher prices disappears. With the retail liquidity wiped, the immediate bullish catalyst is removed from the exchange order books. The asset then becomes highly vulnerable, sitting deep within the 72,000 to 76,000 macro resistance block without further buying support. Navigating this high volatility sweep requires an exchange environment with minimal platform latency. High slippage, the difference between the expected price of a trade and the price at which the trade is executed, can mathematically invalidate retail stop losses during these windows. Utilizing a low slippage exchange is necessary to manage risk when attempting to short this specific resistance rejection. The push towards 74.1K should be viewed as an area to exit existing long positions rather than a signal to buy a breakout. The broader macroeconomic environment dictates the direction of high-risk assets, including cryptocurrency. The S&P 500 shares a high correlation with the crypto market. When equities trend lower, they consistently limit the upside of digital assets. Over the past 2 weeks, the U.S. stock market has experienced a sharp downward trajectory, showing significant internal weakness. A sustained crypto breakout is highly unlikely to occur while traditional financial markets are undergoing a broad sell-off. Data suggests that a breach of the 76,000 macro resistance requires a corresponding bullish turnaround in the S&P 500. Since the stock market is closed on weekends, crypto price action creates a false sense of independent strength that often vanishes upon the Monday open. When the traditional equities market reopens, watch for a shift in momentum indicators to confirm if a broader risk on sentiment is returning. A lasting crypto breakout would require the S&P 500 to establish a series of higher highs, indicating institutional support for risk assets. Given the current performance of traditional finance, the probability of these bullish conditions being met in the immediate term is low. Until equities reverse their trend, upward moves in crypto are likely temporary anomalies that will eventually align with the broader market's downward pressure. As Bitcoin dominance moves sideways, the rest of the altcoin market remains functionally paralyzed, unable to establish independent trends. Ethereum is currently testing a historical resistance ceiling at the 2200 level. An Ethereum breakout lacks structural support if Bitcoin cannot definitively hold above its own macro resistance at 76,000. Attempting to front-run these altcoin rallies in this environment often leads to being caught in a false breakout. Major assets like Solana and XRP are currently exhibiting similar vulnerable setups as they approach their respective ceilings. Upside for these assets is currently limited by strict horizontal resistance, specifically $95 for Solana and $1.50 for XRP. These secondary assets will remain capped until the primary market leader clears the macro resistance wall standing in its way. A liquidity sweep is a mechanical event, not a macro breakout. Monitor the 74.1K level as the primary trigger point for algorithmic volatility. The S&P 500 remains the decisive indicator for whether a crypto rally can be sustained or if it will be forcefully corrected. Recognizing the resistance trap is only half the process. You must have a precise strategy for entering the short position upon reversal. Correctly timing the rejection trade at these key levels is the only way to convert an engineered trap into a capital-protecting event.